It is Thursday, June 18th, 2026. And if you look at the global economy right now, it feels a lot like a giant, wildly complex machine where somebody just yanked the main control lever.
And we are actively tracking the massive ripple effect of that yank. We're talking about a sudden, sharp change in the rules of money from the Federal Reserve, colliding with the wild, historic hangover from Friday's SpaceX market debut.
Which is really the overarching mission for our exploration today. We are tracking the invisible levers currently driving prices and valuations. We want to look at the actual mechanics behind what things cost, starting with the macro price of borrowing money, all the way down to the unit economics of your morning coffee.
The common thread binding all this macroeconomic data to those micro-consumer choices is inelasticity. We are witnessing several distinct scenarios where human habits, pricing structures, and capital flows just absolutely refuse to budge, regardless of the pressure applied to them.
To understand why the broader market is so jittery right now, we have to start at the absolute top of the financial food chain. We have to look at the price of money itself. The Federal Reserve just concluded its first meeting under the new chairman, Kevin Warsh, and they held interest rates steady at 3.5 to 3.75%.
Holding those rates steady was entirely expected by institutional investors, considering inflation is currently running at an above-target 3.8%. That inflation is driven in large part by energy spikes resulting from the U.S.-Israel conflict in Iran, which is impacting the Strait of Hormuz shipping lanes, so the specific rate decision was not the shock.
The shock was the mechanical way Warsh chose to operate the institution. He radically shifted the Fed's communication style. The traditional policy statement from the Fed is usually this heavily parsed, complex document running well over 300 words.
Warsh slashed it down to a blunt 132 words. He focused entirely on what he termed price stability. He even told reporters directly, quote, "Inflation is a choice. You bet it is."
He also went much further in dismantling the Fed's traditional transparency mechanisms. I want to unpack this, specifically the tool called the dot plot. For anyone who doesn't spend their days analyzing central bank releases, how does that mechanism actually function, and what did Warsh do to break it?
The dot plot is a visual grid. The 19 members of the Fed committee anonymously project their expectations for future interest rates. Each member places a dot representing where they think rates should be at the end of the year. It has historically been the cornerstone of market forecasting because it literally maps out the central bank's collective mindset.
But at this specific meeting, Warsh refused to submit his own dot. He allowed his colleagues to submit theirs, which actually showed a 9-to-9 split between those expecting steady rates or a cut versus those expecting a hike, but he personally refused to tip his hand.
By withholding his projection, he actively devalues the projections of the rest of the committee. Any discussion about the future path of interest rates now carries this massive caveat that the single most influential official will not state his opinion.
It is literally like a new casino boss sitting down at the high-stakes poker table, flatly refusing to show his cards and forcing everyone else to change their betting strategy simply through intimidation and silence.
That silence creates profound mechanical implications for the bond market. That maneuver saves him from taking an immediate, difficult vote on how to formally change central bank communications, but it instantaneously removes the market's safety net. Financial media reported that the policy-sensitive two-year Treasury yield immediately spiked by over 14 basis points in response to this silence.
Let's clarify what a 14 basis point spike actually means for the average consumer or business, because a basis point is simply 1/100th of 1%. An increase of 0.14% sounds microscopic.
When you apply that to the trillions of dollars moving through global debt markets, it represents a massive, sudden repricing of short-term risk. The two-year Treasury yield is essentially the market's direct bet on what the Fed will do in the near future. When that yield spikes, it means traders realize aggressive rate cuts are completely off the table.
Bond investors like Jeffrey Gundlach are already pointing out that Warsh is not the easy money chairman many hoped for, which makes long-term U.S. Treasuries a much different proposition. Warsh is deliberately dismantling the era of forward guidance.
For years, the Fed has held the market's hand, telegraphing every move well in advance so banks and corporations could plan their borrowing. By making the central bank inherently less predictable, Warsh forces markets to actually price in risk on their own, rather than relying on the Fed to prevent volatility.
To institutionalize this uncertainty, he launched 5 separate task forces to rethink how the Fed communicates, the optimal size of its balance sheet, its data sources, the mathematical link between productivity and jobs, and its entire foundational framework for managing inflation.
That structural reset at the macro level is colliding with some fascinating behavioral economics at the micro level. We can observe how consumers react to this prolonged inflation pressure just by looking at the unit economics of a morning coffee.
A standard iced latte is currently pushing towards $6.70, which is roughly 5 British pounds for our listeners in the UK.
The economics of that standard coffee represent a perfect storm of supply chain chaos. The physical reality of growing the underlying beans is buckling. Vietnam is suffering a severe drought that is crushing the Robusta bean crop, with rainfall dropping a staggering 30%. Simultaneously, we are still seeing the lingering agricultural effects of a 2021 frost in Brazil that severely damaged the Arabica bean harvests.
Geopolitical shipping disruptions add an entirely separate layer of cost. Ships carrying those Vietnamese beans to Europe are being forced to route all the way around the southern tip of Africa to avoid militant threats in the Red Sea, adding 4,000 miles to the journey.
Regulatory compliance is also driving up the unit cost. New European Union anti-deforestation rules mean suppliers will soon have to provide the exact GPS coordinates of their plantations. Officials will check those coordinates against satellite imagery to ensure the land was not recently a protected forest.
The administrative cost of building that tracking infrastructure gets passed directly down the chain to the consumer. But how are the new sweeping U.S. tariffs impacting this specific market? Because the global coffee belt happens to intersect perfectly with the countries targeted by the new tariff glut.
The tariffs caused a profound distortion. Vietnam faced a 46% tariff, while Brazil faced a 50% tariff. As a direct result, U.S. roasted coffee prices surged 17%, making it the single fastest rising item in the entire inflation basket outside of fuel oil.
Brazilian exports to the U.S. more than halved, diverting massive amounts of coffee to Germany instead. This highlights a fundamental mechanical flaw in using tariffs to punish countries for perceived trade manipulation. Vietnam's dominance in Robusta beans is not an artificial subsidy. It is the economic principle of comparative advantage, based entirely on their subtropical climate and specific labor costs. You simply cannot reshore coffee production to the United States.
The technological adaptation by the farmers on the ground is incredible. In Vietnam, thousands of farmers wake up at 4:30 in the morning to check their smartphones for the global commodity price of Robusta beans. Because that real-time pricing data is so accessible, they are choosing to store their beans in warehouses rather than sell them immediately after harvest.
They are actively playing the global commodities market from their phones, holding out for higher prices. Yet despite this cascading series of supply shocks, shipping diversions, tariffs, and farmer holdouts driving up the underlying commodity price, consumer demand is not dropping.
This is the core definition of inelastic demand. Consumers are absorbing the $6.70 cost, and beverage companies are deploying two distinct strategies to manage the margin pressure: premiumization and automation.
Premiumization makes the product look fancier to justify the margin. Coffee shops are pushing bright green matcha or elaborate cold brews because the aesthetic appeals to the social media generation, shifting the product from a simple caffeinated beverage to a curated experience.
On the other end of the spectrum, we see intense automation. The British bakery chain Greggs is keeping consumer prices low by deploying highly automated bean-to-cup machines, which has quietly made them the largest coffee provider in the UK.
The inelasticity of the coffee drinker becomes striking when contrasted with the rest of the retail sector. Consumers are unshakable on their daily caffeine habit, but they are brutally rejecting price increases in apparel and electronics. Lululemon recently slashed its full-year guidance, with North American sales actively falling.
Their profit margins are being hammered by the exact same tariff pressures hitting the coffee beans. Lululemon reported that tariffs impacted their margins by 2.8 percentage points.
Why are we perfectly willing to value max our wardrobes and hold off on premium yoga pants, but we absolutely refuse to downgrade that daily $6.70 iced latte?
The demand for premium athletic wear is highly elastic. A consumer can delay buying a new pair of leggings indefinitely. Lululemon is attempting a massive operational turnaround, hiring former Nike executive Heidi O'Neill and trying to reduce their product lead times from 24 months down to 12.
The broader retail trend shows that value-focused retail is thriving, while premium discretionary goods suffer. Kohl's saw its stock jump 20% by successfully appealing to squeezed middle-income shoppers. Their CEO explicitly noted that families are sitting around the kitchen table trying to make life work amid persistent inflation.
Best Buy beat earnings expectations by focusing on helping consumers optimize their existing technology rather than forcing expensive new upgrades. Small, habitual luxuries survive inflation much better than large, infrequent purchases.
We view the caffeine in the morning ritual as a non-negotiable mental health utility, while the clothing upgrade is viewed as purely discretionary. By the way, if you enjoy exploring these kinds of invisible market forces, you can find financial candy, brain candy, and classic audiobooks over at clarineratio.com.
Consumers may be penny pinching at the mall, but institutional capital is flowing into frontier technology at an unprecedented rate. We really need to examine the sheer staggering scale of Friday's SpaceX market debut. The numbers break almost every historical precedent we have for a public listing.
On its first day alone, SpaceX saw $85 billion in trading volume. For context, I want to compare that to the rest of the market. The sources note that this volume is larger than the massive exchange-traded funds QQQ and SPY.
QQQ is the ticker for the massive index fund tracking the Nasdaq 100, representing the biggest technology companies in the world. SPY is the fund tracking the entire S&P 500. Friday's SpaceX debut generated more daily trading volume than the funds representing the entirety of the U.S. tech sector and the top 500 American corporations combined.
The company's valuation hit $2.66 trillion, temporarily eclipsing Amazon and officially making Elon Musk the world's first trillionaire. But the financial mechanics reveal a massive disconnect between that valuation and traditional revenue generation. Amazon generates almost as much revenue in a single week as SpaceX did all of last year.
Amazon's net income for the year was roughly $78 billion, which was more than quadruple SpaceX's total gross revenue. SpaceX is actively losing billions of dollars a year to fund its infrastructure. Institutional investors are clearly not pricing in current profits.
They are pricing in a perceived, untouchable monopoly on the future infrastructure of space exploration and artificial intelligence. We can see this evidenced by the $60 billion stock acquisition SpaceX made of the AI coding startup Cursor, executed literally within days of going public.
That acquisition is the tip of the spear for the broader agentic AI boom.
What exactly separates agentic AI from the chatbots we have been using for the past few years?
The industry's moving from AI that merely answers a user's prompt to AI agents that independently execute complex, multi-step tasks in the background. A traditional chatbot waits for you to ask it a question. An AI agent is assigned a goal like organizing a database or writing a software patch, and it continuously queries systems, writes code, tests that code, and revises it without human intervention.
There is a hidden massive cost to this architectural shift, perfectly illustrated by the data analytics company Databricks. Their annualized revenue growth is topping 80%, reaching yearly $6.9 billion. If their revenue is climbing that fast, why are their profit margins actively shrinking?
Databricks operates on a consumption-based business model. Because AI agents operate autonomously in the background, they continuously run processes and check systems. Databricks CEO Ali Ghodsi explained that more agents equals exponentially more queries hitting the database. Every single query requires server processing power, which drives up the underlying infrastructure bills.
If agentic AI is like hiring 1,000 digital interns who enthusiastically do the work but eat all the incredibly expensive compute snacks in the break room, at what point does the cost of running the AI exceed the value it actually creates for the business?
That is the defining existential question for the software industry right now. Companies are actively shifting their internal policies. They are moving from a strategy of token maxing, which meant encouraging employees to use as much AI as possible to drive innovation, to a strategy of value maxing.
Under value maxing, corporate IT departments restrict the use of expensive, powerful frontier models like Anthropic's Mythos only for highly complex tasks, and force employees to use cheaper, open-source models for mundane daily chores. Furthermore, this proliferation of autonomous agents creates a massive vulnerability in corporate networks.
Cybersecurity firms like Okta are seeing a massive spike in demand because of this architecture. If you have thousands of autonomous AI agents operating within a company, logging into databases and executing commands, you need entirely new identity security tools.
You have to verify that an agent acting on behalf of an employee is legitimate and not a malicious program executing an automated cyber attack.
Okay.
Okta's stock jumped 8% precisely because they're building the security verification plumbing for this agentic future.
The pursuit of this computational power is pushing physical supply chains to literal extremes. To process these massive, continuous AI workloads efficiently, future data centers will increasingly rely on quantum computers.
Quantum processors operate at the subatomic level, and to maintain stability, they must be cooled down to near absolute zero. Achieving those temperatures requires an incredibly rare isotope called helium-3. It costs roughly $2,000 a liter. Why is the physical supply on Earth so restricted?
Earth's current supply is almost entirely tied to the radioactive decay of tritium inside existing nuclear weapons. It is not an element you can easily synthesize in a lab or mine from the Earth's crust in commercially viable quantities. The terrestrial supply is practically non-existent compared to the projected demand of quantum data centers.
The demand for compute cooling is so intense that startups like Interlune are genuinely planning to launch a lunar lander in 2027 to mine moon dust, known as regolith, just to extract helium-3.
The mechanics of that extraction are staggering. They plan to send autonomous excavators to the lunar surface. Those machines will have to crush, heat, and churn through hundreds of thousands of tons of lunar dirt to capture a single kilogram of the isotope and then load it onto a return vehicle to fly back to Earth.
They're calculating that the unit economics of building a rocket, flying to the moon, establishing an autonomous robotic mining operation, and returning the payload makes financial sense. The tech industry's need for quantum compute cooling is that inelastic.
The market validates that calculation. A Helsinki-based quantum computing company has already signed a $300 million deal with Interlune to secure future deliveries of that lunar helium-3.
The underlying mechanisms of how we assign value and pay for resources are shifting dramatically. Kevin Warsh is holding interest rates high and forcing bond markets to price their own risk. Climate shocks and global tariffs are permanently altering the cost of a daily coffee. The hidden astronomical compute costs of autonomous AI agents are driving venture capital to literally fund lunar mining operations.
Every one of these macro-level structural changes eventually trickles down to alter human behavior on a micro level. Take tipping, for instance. In places like Iceland and the UK, tipping is spiking right now.
Not because of minimum wage laws like in the US, but because the software UI on digital payment terminals now automatically prompts for 15 or 20%. The software default quietly removes the mathematical friction of calculating a tip and replaces it with psychological pressure.
It turns a simple purchase into a complex social calculation. The frictionless design of that technology effectively exports American wage structures and reshapes cultural norms across continents. The architecture dictates the outcome.
Next time you tap your card at a counter, ask yourself, are you making a calculated financial decision, or did the software architecture just quietly make it for you?